Okay, Assalamualaikum warahmatullahi wabarakatuh. We are from Group Service 6 and today we will present about one of the audit planning topic, which is scope of audit. Scope of audit is containing about three subtopic, which is engagement letter, fraud and error, and lastly settings audit objective. Engagement letter. Okay, what is actually engagement letter means? Engagement letter is actually a letter made by the auditor to the client. It contains the agreement between auditor and client for the conduct of audit and other services. The letter will be sent to client upon engagement before commencement of the audit. Okay, now, what is the purpose of the engagement letter? The first one is to provide written confirmation of the acceptance of appointment. Next is to clearly define the auditor's responsibility and objective and scope of audit. The last one is to minimize the possibility of misunderstanding between client and auditor. Okay, now let us see about contents of engagement letter. The objective and scope of audit, the responsibilities of auditor, management's responsibility for the financial information, identification of the applicable financial reporting framework for the preparation of financial statements, reference to the expected form and content of any reports, ISA 701, communicating key audit matters. A statement that there may be circumstances which the report may be differ. The terms of the engagement, which is including a statement that because of the test nature and other inherent limitations of the audit, there is an unavoidable risk that some material misstatements may remain undiscovered. Access to whatever information the auditor requires, a request for the client to confirm the terms of the engagement by acknowledging receipt of the letter. Any other matters relevant fees, assistance from client's staff. For recurring audit, new letter may be sent if there is a change in the nature and size of the client's business. As you can see, this is the example of engagement letter.
Next, we go to fraud and error. Fraud involves intentional misstatement or deceptive action designed to deceive financial statement user, such as investor, creditors, or other stakeholder. The scope of audit work related to fraud includes: first, risk assessment. Auditors conduct risk assessment to pinpoint area of increased fraud risk, considering factors such as management's tone, industry-specific risk, and past fraud incident. Number 2, testing for fraud. Auditor create audit procedure to detect fraud by examining financial statement, transaction record, and documentation, potentially involving forensic audit technique and detailed analysis. Number 3, assessing internal controls. Auditor assess the effectiveness of internal control for fraud prevention and detection, including the design and implementation of controls to address fraud risks. Lastly, consideration of fraud risk factor. Auditor assess fraud risk factors such as related party transaction, financial fluctuation, and potential fraud source within and outside the organization.
We move to the next slide. What is errors? Errors in financial statements are unintentional misstatements, often caused by clerical, accounting, data entry, or misunderstandings of accounting principles, and auditors typically address these issues. Auditor scope of work related to errors typically includes: first, review of accounting policies. Auditors ensure consistent application of clients' accounting policies in accordance with accounting standard, as inconsistency can result in financial statement errors. Secondly, evaluation of internal controls. Auditors evaluate the efficiency of internal controls like duty segregation and reconciliation procedures to prevent and detect errors, with strong controls reducing error risk. Thirdly, testing for material misstatement. Auditors conduct substantive testing to detect material misstatement in financial statement, verifying account balance, transaction, and disclosures accuracy.
Setting audit objectives. An audit objective is an assertion translated into terms that are specific to the particular balance or class, the entity's circumstances, nature of economic activity, and the accounting practices of its industry. Management assertion express or implied representations by management about classes of transactions, account balances, and presentation and disclosure and are reflected in financial statements. Auditors need to obtain evidence that supports each of the assertions for every material component of the financial report. A component of the financial report may be an account balance or group of account balances, a class of transactions, or a disclosure. The categories of assertions provide a framework for developing a specific audit objectives.
Next, I will talk about setting audit objective. The most efficient way to conduct audit is to obtain some combination of assurance for each class transaction and for the ending balance in the related account. There are several audit objectives that must be met before auditor can conclude that the transactions are properly recorded. Audit objectives for each class of transaction include transaction-related audit objective, presentation and disclosure related audit objective, balance related audit objective. So this is the example balance and transaction affecting those balance for account receivable. The beginning balance audit in the prior year considered reliable. Ending balance was correctly stated only if the auditor could be completely sure that each of classes of transaction was correctly stated. That's all from us. Thank you.